Welcome to the Deep Dive. We're your shortcut to understanding the big financial stories. Today we're tackling the Q3 2025 earnings and, maybe more importantly, the growth outlook for a really major global data, analytics, and technology player. So our mission here is simple. We'll unpack the source material you've got, boil it down to what matters. Their financial health right now, the big strategic bets they're placing, and honestly, some pretty surprising market shifts happening around them.
Yeah, and what jumps out immediately from these reports is that this company is really at a turning point, a real inflection point. They've finished this huge cloud transformation, and they're moving into what they're calling a post-cloud phase.
Post-cloud. Okay.
Right. And the whole strategy now seems to be about leveraging AI, leveraging their unique data, both to fight a really intense price war that's broken out, and also to go after these massive new government contracts that have just sort of opened up.
And you can already see that translating, right? The Q3 numbers look pretty solid. Revenue hit $1.54 billion.
That's right, $1.54 billion. And that's up 7% in constant currency year over year.
Okay. And adjusted EPS.
Came in strong at $2.04 per share. And, critically, they bumped up their full-year revenue guidance again. The midpoint's up by about $40 million.
Impressive.
And it's worth remembering the backdrop here. I mean, they pulled off this momentum, raised guidance for the third time this year, despite, ongoing headwinds. Hiring still tough. Mortgage markets were sluggish for most of the quarter.
Right, high interest rates.
Exactly. So it really does show that their strategic bets are starting to, execute. They're diversifying revenue.
Okay, let's get into that scorecard then. The core financials. Where did that stronger than expected revenue actually come from? The sources mentioned a late quarter pickup in U.S. mortgages when rates dipped a bit.
Yeah, that helped, but also really strong performance in their non-mortgage areas. You saw good results in USIS, that's U.S. Information Solutions, and also Workforce Solutions.
Okay, Workforce Solutions, we'll come back to that.
Definitely. But this is where you really see the cloud payoff, right?
Yeah.
They keep talking about being post-cloud.
Hmm.
What that means practically is the really heavy lifting, the expensive part, is done. Now it's about efficiency gains.
Right.
So the sources note they took a final restructuring charge, about $44 million in Q3. Seems like the last piece of it.
Okay.
But those changes, they're expected to deliver about $30 million in ongoing annual savings by late 2026.
That's a decent return. So where does that efficiency actually, show up now on the balance sheet today?
Margins. Look straight at the margins. That's the clearest indicator. International adjusted EBITDA margins, up 360 basis points compared to last year. That's huge.
360. Wow.
And USIS margins were up 130 basis points too. The cloud transition just fundamentally lowers their cost to serve each customer.
Right.
So every dollar of revenue is, more profitable now. They're really starting to see the benefits flow through.
They certainly are. And their capital allocation looks strong too, returning cash to shareholders.
Yeah, about $360 million went back to shareholders this quarter. That included buying back 1.2 million shares for $300 million.
But the metric that really caught my eye was free cash flow guidance. Raised again.
Raised again. Now between $950 million and $975 million for the year. And get this, cash conversion is over 100%.
Over 100%. Explain that for us.
It's incredibly strong. It basically means they're collecting cash from their customers faster than they're recognizing the profit on paper.
Ah.
Sign of really tight operations, clean balance sheet management. And that kind of cash generation, that stability, it gives them the firepower they need for this next bit.
Right. Which is where things get, as you said, really interesting. This mortgage score pricing war.
Yeah.
This isn't just like normal competition. This is a full-on battle for the federally guaranteed mortgage market.
Exactly. And it wasn't even started by them. It was triggered by, let's call it an aggressive move by their main competitor, FICO.
FICO, right. The dominant player for decades.
Dominant, yes. And their price for that key mortgage score. The sources show a compound annual growth rate, CAGR, of over 100% in the last 4 years.
100% CAGR. That's aggressive.
It's more than aggressive. And it culminates in an expected doubling of the price, 2x, hitting potentially $10 per score in 2026.
$10 for one credit score pull in a mortgage application?
$10. In a market that's highly regulated, where lenders are already squeezed on margins, it's, the company calls it an unprecedented catalyst.
I bet. So how did this company respond?
Immediately. And very, very pointedly, they announced new pricing for their competing score, Vantage Score 4.0 for mortgages, at $4.50 per score.
50 versus 10, that's less than half.
Over 50% lower, yeah. And crucially, they guaranteed that $4.50 price will hold firm right through the end of 2027.
Okay, that guarantee is key, isn't it? It gives lenders certainty if they switch.
It's all about encouraging conversion, making it easier to leave that traditional monopoly score.
But hang on, switching isn't easy, right? We're talking about systems that have been built around FICO for like 30 years, deeply embedded in mortgage origination.
Absolutely, that's the hurdle.
Is a $10 FICO score really enough to make lenders undertake that massive, potentially risky migration?
That is the million-dollar question,
Yeah.
or maybe the $100 million question. The sources do acknowledge it's tough. These legacy systems run deep. But look at their strategy to overcome it. This is the real nugget, I think.
Okay.
They're giving away Vantage scores for free, completely free, through the end of 2026.
Giving them away. To whom?
To all their mortgage, auto, card, and consumer finance customers who
Yeah.
are currently buying FICO scores from them.
Ah, so if you buy FICO, you get Vantage Score free alongside it for the next couple of years.
Exactly. It removes the cost barrier completely, lets lenders test it, integrate it slowly, get comfortable with it, all while seeing that $10 FICO price tag looming in 2028.
That makes the 55% saving look very attractive down the line.
It makes the economic case almost unavoidable, right? It's explicitly designed to break that switching inertia, that 30-year habit.
Okay, so financially, what's the upside here if this gamble pays off?
It's potentially massive. The sources estimate that converting customers to VantageScore 4.0 could generate an extra $100 million in annual profit.
$100 million.
And that's at current sort of depressed mortgage market levels.
Mm-hmm.
If the market recovers to more normal volumes,
Doubles.
could double, yeah. Potentially $200 million a year. They're calling it a new profit pool, and honestly, it's one created almost entirely by their competitors' pricing strategy.
Fascinating. A real case study in market disruption. Okay, let's pivot. There's another big growth engine here. Workforce Solutions, EWS. The employment and income data side.
Right. EWS grew 5% overall this quarter. But the interesting parts were consumer lending, up 20%.
20%. Wow.
And the government vertical, that grew high single digits. And the government opportunity, well, it looks absolutely enormous right now.
They're targeting a $5 billion market, right? Specifically going after that huge problem of improper payments in social services and taxes.
Exactly. The estimate is governments improperly pay out something like $160 billion a year. And EWS thinks its data can significantly reduce that.
What's the trigger, though? Why now?
Legislation. It always comes back to regulation, doesn't it? There's new post-OB3 legislation, Omnibus 3, signed back in July.
Okay, OB3.
And it permanently, significantly tightens the verification requirements for social benefits, raises the bar for accuracy.
So what's the immediate pain point for states? Why do they need these solutions urgently?
Well, here's the kicker. The sources say over 80% of states currently don't meet the new mandatory 6% error rate for income verification in SNAP.
SNAP, that's the Food Assistance Program.
Right, Supplemental Nutrition Assistance Program. And if states fail to meet that 6% threshold, the feds could shift the cost of those errors back to the states.
How much are we talking?
But potentially $12 billion in SNAP could boomerang back onto state budgets.
$12 billion. Okay, that is a massive, massive incentive for states to get their verification right, like yesterday.
Precisely. Suddenly, buying accurate, comprehensive verification solutions isn't just a nice-to-have, it's a budget necessity.
So they need the best data possible immediately.
Exactly. Which is why the company's rolling out new tools. Things like continuous evaluation products tracking income changes for SNAP or hours worked for Medicaid recipients. And they just launched something called the Complete Income Solution in Q3. That helps verify not just W-2 income, but also gig work, self-employment, the whole picture.
Directly addressing that $12 billion state-level headache.
That's the idea. Solve the regulatory and financial pain point.
That kind of targeted product development suggests, the internal innovation engine is really humming. Let's look at their NPI, new product innovation, the Vitality Index.
Yeah, the Vitality Index, that measures how much revenue comes from products launched in the last 3 years. It hit a record 16% this quarter.
16. Their long-term goal is 10%, isn't it?
It is. So 16% is way ahead.
Yeah.
It's so strong, actually, that they raised the full-year VEX guidance for the third time, now expecting 13%.
And that's driven by AI, EFX.AI.
That's what they're saying. The move to this EFX.AI platform, enabled by being post-cloud, is accelerating everything.
So what does post-cloud plus AI actually let them do?
Speed, mostly. Because the data is all standardized on the cloud now, they can build and deploy AI models much, much faster. The number of new products using EFX.AI this year, up 3x compared to 2023.
3 times.
Yeah.
No.
And they claim basically all new models are built on this platform now, and crucially, they deliver, on average, over a 30% performance lift for customers versus the old legacy models.
Faster, better performance. Can you give some examples of these new AI-driven products?
Sure. They're tackling really complex fraud problems, things like synthetic identity fraud, first-party fraud.
First-party fraud, that's where the person's real, but they never intend to pay.
Exactly.
Yeah.
Tough to spot. But also, they're building tools for smaller players. Like they launched Ignite AI Advisor.
Ignite AI Advisor.
Yeah, it's a generative AI chat tool. Think ChatGPT, but for lenders. It helps smaller banks or credit unions analyze their own data, assess portfolio risk, stuff that used to require expensive data science teams.
Making sophisticated analysis more accessible.
That seems to be the goal, lowering the
Oh,
barrier.
let's bring it back to the foundation, the data itself, specifically the work number, TWN. That's their proprietary employment database.
That's the crown jewel, yes.
Yeah.
199 million active employment records now, up 9% year over year. It's huge and growing.
Why is having that unique data so important strategically, especially now?
Differentiation. In the core credit reporting business, which can feel like a commodity, TWN data is the differentiator, and they're leveraging it very smartly with this twin indicator strategy.
Twin indicator. Okay, what's that?
They're essentially packaging key employment data, like are you working, who's your employer, maybe even historical income trends, and providing it alongside the traditional credit file.
For free.
At no extra cost to the lender, yes. Bundled in.
The goal being, make their credit reports stickier, drive share gains.
Exactly. Make their core offering more valuable than the competition's. And there's some evidence it's working, that strong 26% growth in USIS mortgage revenue. They partly attribute it to new pre-approval products using this twin indicator.
Because it gives lenders a fuller picture.
Right. Especially for the millions of people who are credit invisible, no traditional file or those with thin files. Adding verified employment data suddenly makes those consumers much more understandable, more lendable.
That makes sense. And is this twin indicator just for mortgages?
No, they're rolling it out. It's already live for mortgage pre-approval, as we said, and for auto dealers. They expect to launch it for personal loans, P-loans, and credit cards in the first half of 2026.
So embedding this unique data across all their major lending verticals.
It becomes their strategic moat, Makes it harder for customers to even think about switching down the road, even beyond the current price wars.
Okay, let's try and wrap this up. Summarizing what we've dug into today. It feels like a story of solid financial performance, yes, but really underpinned by 3 big strategic moves.
I think that's right.
First, this very bold, aggressive play in the mortgage score market, aiming for that, $200 million potential profit pool?
Yep, driven by competitor pricing.
Second, really leaning into these huge government opportunities that have been cracked open by that OB3 legislation.
That $12 billion state problem is a powerful motivator.
And third, really capitalizing on being post-cloud, using EFX.AI to drive innovation at a record pace.
Faster, better products, leveraging their unique data.
So what's the key takeaway for you listening to this?
I think it's that the future of lending isn't just about the traditional credit score anymore. It's about combining that static data with more dynamic alternative data. Things like verified employment, verified income, like we see with the twin indicator. It creates a much fuller, probably fairer picture of someone's ability to handle credit.
More complete data means better decisions for lenders, potentially more access for borrowers.
And obviously growth for companies that can provide that integrated view.
Okay, so let's leave you with a final thought to chew on. We talked about that OB3 legislation, the mandatory changes coming, and the fact that over 80% of states are currently failing that new 6% error rate for SNAP benefits.
Yeah, that's a stark number.
So the question is, how dramatically are state government budgets and priorities going to shift towards buying data verification and integrity solutions over, say, the next 2 years? We're potentially talking billions shifting towards this kind of technology.
Definitely something to watch. We'll leave that thought with you. Thanks for diving deep with us today.